In a recent event, Federal Reserve Jerome Powell emphasized the need to keep long-term inflation expectation anchored. The market interprets this as a pushback against Fed put, where Federal Reserve will pump liquidity and lower interest rate using its monetary policy to pump up the U.S. stock market and economic growth. This reiterates Fed's dual mandate, which is a balancing act between inflation and unemployment. This signals a current priority in inflation control over the boost of the economy. Powell also warned a potential stagflation scenario where you have rising prices and higher unemployment, and calling this a challenging scenario for the Fed, as monetary policy would be stuck in that scenario, because if you raise interest rate, that would cause the unemployment rate to get higher. If you lower the interest rate, that would cause the inflation to get worse. Powell said that to deal with this scenario, Federal Reserve would weigh inflation's distance from its 2% target, labor market weakness, and recovery timeline when setting monetary policy. So I think stagflation driven by tariff is a supply-side man-made situation, and in such a case, a priority should be given to boost the economy and provide liquidity, because market forces will eventually correct the price over time and get through the man-made trade barriers. As a result, this type of man-made inflation could be transitory. As a result of Jerome Powell's emphasis on inflation control, U.S. 10-year and 5-year Treasury yields are declining. The decline in the yield indicates lower inflation expectation from the market. Trump is frustrated that Jerome Powell isn't cutting rate fast enough to support the economy and the U.S. stock market. If we look at the situation on a bigger picture, there has been a divergence between the 10-year Treasury yield and the dollar index, because before April 2nd, the two things move in the same direction. But after the April 2nd, the Liberation Day, there has been a clear divergence between the two. This is indicating a capital outflow from the U.S. So less money is being invested into the U.S. market, including every sort of market, treasury market, equity market, for example. This outflow of funds is due to the expectation that U.S. deficit would shrink in the future. Trump criticized Powell, calling him too late, and said Powell's termination cannot come fast enough. This contrasts what he said in July 2024, where he said he would let Powell finish his term. Jerome Powell's term ends in May of 2026. As a president of the United States, removing the chairman of Federal Reserve or central bank of the country prematurely is very difficult due to the Federal Reserve Act, which promised independence of Federal Reserve. But this is not impossible. On the trade war front, it's showing no signs of easing. The Trump administration implemented 90-day pause on reciprocal tariffs on all countries except China, lowering them to 10% during the 90-day pause to give him time and room to negotiate. This is used as an opportunity to pressure other nations to curb trades with China. As many countries seek tariff reduction or elimination, this gives U.S. negotiation power and leverage. In return, the U.S. is asking them to limit China's manufacturing influence. A key focus is to stop the transshipment, where the Chinese goods are rerouted through a third country to bypass the tariff. And there's also rumor suggesting U.S. may be pushing Mexico to raise tariff on Chinese EV. This aligns with my earlier prediction in my previous videos around the time when Trump started his second term. My prediction was that Trump would focus on ending the war in Ukraine fast and quick, so that he has energy to focus on dealing with China for the rest of his term economically. And as we can see, this has been the case, even though the ceasefire isn't working too well right now. So China is currently facing deflationary pressure in its economy. So US-led trade pressure is going to add economic strains on China. As a result, this may push China towards the negotiation table. So according to people familiar with the matter, China actually laid out a set of preconditions for negotiation with US. Number one is the demand for respect. This could be a response to J.D. Vance's Chinese peasant remark.
We borrow money from Chinese peasants to buy the things those Chinese peasants manufacture. That is not a recipe for economic prosperity. It's not a recipe for low prices, and it's not a recipe for good jobs in the United States of America.
The second condition is unified messaging. China is frustrated about mixed signals received from the White House. Some officials have hawkish comments towards China, some have dovish comments, so Chinese are getting confused. So the third point is related to the second person, where China wants Trump administration to appoint a clear lead negotiator in the trade talks. So China wants a unified American voice to provide consistency and less noise. So a U.S.-China deal is still possible before full economic decoupling between the two countries. However, the trade war is still escalating. China ordered its airlines to halt further delivery of Boeing jets and parts due to high tariffs, making them impractical. This benefits Airbus, which is Boeing's European rival. The move is a major blow to Boeing because China was projected to be the largest market for Boeing in the next 20 years. The US has also implemented a new export control of NVIDIA's China-specific H20 AI chip. But this ban is actually hurting NVIDIA a lot because it makes the H20 chips unsellable, costing NVIDIA estimated $5.5 billion in lost revenue. Because the H20 chips is a dumbed-down version of its AI chip. It's a China-specific chip to comply with the earlier export restriction. A sudden ban of such chips will cause the chips to be sold to nowhere because nobody wants a dumbed-down version of the AI chip. Everybody wants the latest and greatest. And China is also working on implementing measures to target U.S. services sectors because the tariffs only applies to goods, not services. The key area affected including the U.S. entertainment sector, tourism, and education sector. The U.S. consistently runs a surplus in its services exports. In 2024, the U.S. recorded a services trade surplus of around $293 billion. So China is targeting things that are outside of the tariff right now. If trade deals cannot be established, the U.S.-China trade war could eventually escalate further towards full decoupling. Rumors suggest that the U.S. may be considering delisting Chinese stocks from American Stock Exchange. Treasury Secretary Bessent stated that all options are on the table in trade talks with China. So there are two major leverage points that U.S. have not implemented yet. Number one is Chinese ADR delisting, so removing all the Chinese firms from the U.S. stock market, which means they will be removed from a lot of ETFs and indexes. Number two is the U.S. investment ban on China, so restricting capital flow into China. China also have cards to further escalate the trade war by targeting U.S. companies that relies on Chinese consumers. China can increase its scrutiny and restrictions on companies such as Apple and Tesla. Thank you very much.